Let's start with the obvious. President Trump's proposed import levies, 25% tariffs aimed at Canada, Mexico, and a proposed doubling on China's already heavy-handed tariff regime, are not just some abstract policy choices. They're a harbinger of a more isolationist trade policy that, ironically, might be undermining the very economic growth it professes to protect. In recent weeks, gold, the timeless safe haven, has rebounded from last week's sharp correction, trading near $2,870 an ounce. This rise isn't because investors suddenly developed a newfound love for bling, it's a clear signal of the growing uncertainty in the global economy that many believe is being fanned by our own government's short-sighted tariff game. The concept is simple: trade tariffs disrupt and distort global supply chains. When tariffs are levied arbitrarily or without sufficient international negotiation, they create mounting friction in an already strained global economy. When those tariffs target key trade partners like Canada, Mexico, or China, the repercussions are immediate. Already, market sentiment is souring with investors questioning whether a self-induced recession, a blend of sluggish growth and stubborn inflation, might be imminent. In this context, gold's rise is less a celebration of its inherent value and more an investor's desperate cry for economic refuge. Gold's performance in recent weeks tells an unambiguous story. After notching its first weekly loss of 2025 following a record-breaking start, some traders did the prudent thing, booking profits. Yet, as soon as the government hints at more punitive tariffs, gold quickly climbs back. Why? Because in a world where policy seems to flirt with economic sabotage, gold is less an asset than a beacon of stability. Its steady appeal lies in its non-yielding nature. When market volatility increases and the Federal Reserve hints at potential interest rate cuts, investors flee to assets that maintain their intrinsic value, and gold is the ultimate safe haven. Consider this: gold's appeal is rooted in historical precedent. When inflation spikes and growth stagnates, a pernicious combination known as stagflation, investors have always turned to gold. Recent U.S. economic data have spurred fresh fears that we may be teetering on the edge of such an environment. President Trump's tariffs promise to keep price pressures elevated by disrupting supply lines and increasing the cost of imports. The paradox here is stark: in an effort to protect domestic industries, the tariffs may actually stoke inflation, making everyday necessities more expensive for the average citizen while the same policies destabilize the broader economy. As if the gold market's reaction wasn't enough, there's another irony at play. According to the latest figures, the Bloomberg Dollar Spot Index recently eased by a mere 0.1%, insignificant to some, but sufficient to underscore a problematic trend. The tariffs have indirectly bolstered the US dollar, at least temporarily, as international investors react to tighter domestic supply lines in the expectation of higher inflation. However, a stronger dollar is a double-edged sword. While it might look good on paper, it effectively drives up the price of gold for foreign investors, since gold is priced in dollars, thereby artificially inflating domestic gold prices even further. This becomes a self-fulfilling prophecy: the stronger dollar triggers a flight to gold, further cementing its status as a refuge while simultaneously signaling economic distress. The complicated interplay between a stronger currency and a debatable domestic economic outlook suggests a deeper malaise. The government's tariff strategy, ostensibly designed to bolster domestic manufacturing and curb trade deficits, is instead creating a labyrinth of unintended economic distortions. The greenback rises not solely because of fiscal prudence or solid economic fundamentals, but because investors are acting on the belief that the policy mix will eventually push the economy into dangerous, uncharted territory. Recent U.S. economic data are whispering a bleak narrative: stagnant growth coupled with rising inflation, the classic recipe for stagflation. The specter of stagflation isn't new. We all remember the economic chaos of the 1970s. Back then, a combination of oil shocks, unbridled inflation, and misguided government policies left ordinary citizens scrambling. Today, similar warnings are emerging from reliable data sources. For instance, the latest figures from the U.S. Bureau of Labor Statistics show persistent inflationary pressures, even as indicators of economic growth remain tepid. Corporations are reporting lower-than-expected profit margins, even as input costs rise, a situation reminiscent of the stagflation debacle of yore. What does this mean for everyday citizens? Simply put, regular folks are likely to see their purchasing power erode. As prices for everyday goods, food, housing, transportation, continue to drift upward, any benefits of nominal wage increases are wiped out by the relentless march of inflation. Even more concerning is that if the Federal Reserve cuts rates in response to an economy that's teetering on the edge, such policies could further stoke inflation in the long run, exacerbating the situation for workers and families. Trump's approach to tariffs represents a broader, increasingly common theme in modern economic policy: tariff arbitrage. The administration now appears bent on leveraging protectionist policies in a misguided bid to reinvigorate domestic industries. But history teaches us that protectionism is rarely a magic bullet. Instead, it tends to distort market signals, misallocate resources, and ultimately harm both consumers and businesses. For a moment, let's talk about recent historical data and examples that illustrate this point. Consider the Smoot-Hawley Tariff of 1930, a measure intended to protect American jobs but which inadvertently helped precipitate the Great Depression by triggering a global trade war. More recently, the 2018 US-China trade war saw similar dynamics at work. Tariffs imposed on Chinese goods led to significant price hikes in key consumer sectors and contributed to a slowdown in global trade. What these episodes have in common is the short-sightedness of policy, a focus on immediate political gains rather than sustainable economic growth. In today's context, Trump's threat of imposing substantial tariffs on Canada, Mexico, and China carries a similar legacy. The idea is to force trade partners into negotiating tighter agreements, but this strategy risks alienating powerful allies and destabilizing global markets. Already, the reaction has been palpable. While some sectors brace for impact, others are capitalizing on the turmoil to lock in safe assets like gold and silver. Just last week, precious metals like silver, platinum, and palladium all saw noticeable climbs in price, a clear market signal that the economic outlook is anything but secure. Let's ground this discussion in some hard data. According to the latest market reports, spot gold rose by 0.4% to $2,870.26 an ounce in Singapore early this morning, following a significant 2.7% drop last week. Such volatility is a stark reminder that markets are reacting to real, tangible economic concerns, not abstract policy debates. Furthermore, the Federal Reserve's minutes from its last meeting indicate that while there is talk of possible rate cuts, the central bank remains deeply divided on the best course of action in an increasingly uncertain global environment. Adding more weight to the argument, recent surveys among institutional investors reveal that over 60% now view the U.S. economy as being in a precarious state, with many expecting a notable downturn in the near future. This sentiment is not confined to Wall Street alone. Small business owners across the country are reporting tightened credit conditions and rising input costs, a clear sign that the intended benefits of Trump's protectionist policies are not filtering down to the grassroots level. It is high time to call the government's handling of this situation for what it is, a cocktail of hubris, miscalculation, and neglect that is jeopardizing the nation's economic well-being. The tariffs, as proposed, are being implemented without a coherent long-term strategy. Instead, they serve as a knee-jerk reaction to political constraints and a misguided belief that isolationist policies will magically reignite domestic growth. But when you scrutinize the data and listen to the markets, the picture is unmistakable. These measures are accelerating uncertainty and deepening divides in the economy. Moreover, the administration's failure to acknowledge and address the potential for stagflation is nothing short of reckless. By imposing policies that are likely to keep price pressures high, the government is effectively setting the stage for a prolonged period of economic malaise. Meanwhile, ordinary citizens, those very people who need a robust economic framework to thrive, are saddled with the consequences. In an era where economic policies should be elevating living standards and fostering innovation, we are instead witnessing a legacy of policies that threaten to lock the economy into a cycle of decline. If we are to avoid the pitfalls of past economic misadventures, it is imperative that policymakers shift their focus from short-term political wins to long-term economic stability. This means rethinking the role of tariffs, abandoning protectionist policies in favor of comprehensive trade agreements that honor the complexities of the global market, and most importantly, addressing the structural issues that underlie our current predicament. Look at some of the pop culture examples from history. When the U.S. embraced global integration post-World War II, it set the stage for decades of unprecedented prosperity. Free trade, when conducted fairly and responsibly, has the power to transform economies, and the evidence is clear. Recent reforms in places like the European Union and Japan, which focused on balancing competitiveness with social welfare, stand in stark contrast to the unilateral approach we see today. These examples should serve as a beacon for re-engineering U.S. policy. Let's be blunt, no nation exists in isolation. In today's interconnected world, economic policies in one country have far-reaching implications. The tariffs under discussion threaten to unravel decades of economic integration that have fueled technological advancements, improved consumer choice, and driven down costs for millions. The irony is staggering. In trying to shield domestic industries, these policies risk isolating the U.S. from the very markets that underpin its prosperity. For instance, technology companies, which are among the most dynamic sectors of the economy, depend heavily on global supply chains. A 25% tariff on components from key trading partners could disrupt production lines, delay product launches, and ultimately erode the competitiveness of U.S. firms on the international stage. This is not hyperbole, it is a real consequence that has already been observed in preliminary reports from industry insiders. Business confidence is waning, and the prospect of diminished innovation looms large over our national economic agenda. So, what's the solution? First, there needs to be an honest acknowledgement from our policymakers. Economic policies based on protectionism and arbitrary tariffs are not sustainable, they only sow the seeds of long-term economic instability. Instead, we must embrace economic realism, policies that foster global cooperation, encourage innovation, and support robust consumer markets should be at the forefront of our agenda. For starters, rather than resorting to drastic tariffs, the focus should shift to negotiating mutually beneficial trade agreements that promote fair competition and ensure that all parties share in the gains from globalization. Investment in domestic infrastructure, education, and technology can ensure that the economy remains resilient without resorting to measures that isolate it from the world. After all, history is replete with examples where isolationism led to stagnation and decline. We also need to consider monetary policy with a clearer lens. While the Federal Reserve remains cautious about unwinding its policies in the face of mounting uncertainty, its mandate is to ensure stable prices and maximum employment. However, if the government continues to implement policies that drive inflation, the Fed will find itself in a losing battle, juggling rate cuts to stimulate growth, while simultaneously grappling with inflationary forces beyond its control. The result? A potentially vicious cycle that undermines economic stability at its very core. In closing, the latest surge in gold prices amid the threat of sweeping tariffs is more than just a market blip, it is a clarion call for economic sanity. The data are clear, the signs are unmistakable, and the stakes are too high for policymakers to ignore. Instead of resorting to brinkmanship and hope for the best strategies, we need an economic policy that is as practical as it is visionary, a policy that recognizes the inherent interconnectedness of modern economies and values long-term growth over short-term, politically motivated fixes. The current administration's tariff proposals may promise to rein in trade deficits and bolster domestic industries, but at what cost? History teaches us that protectionism is a treacherous path that often leads not to prosperity, but to prolonged economic weak spots marked by stagflation, rising inflation, and ultimately, a diminished global standing. If we are to avoid a fate similar to the economic missteps of the past, a radical rethink is needed, a return to policies that prioritize sustainable growth, genuine economic integration, and a realistic appraisal of global interdependencies. For both everyday viewers and financial professionals alike, the lesson is clear: do not be fooled by the glitter of short-term victories in the commodity markets. Instead, demand for an economic policy that is rooted in reality. The golden halo around bullion is not a sign of market triumph, it is a reflection of fear and uncertainty among investors who see all too clearly the long-term risks posed by protectionist policies. Let this be our wake-up call to policymakers: trade wars and arbitrary tariffs are not the salvation they claim to be, they are the harbingers of economic turmoil. Only by acknowledging the complex interplay of global markets and the need for nuanced policy can we hope to steer the economy back to a path of sustainable growth. And until that day comes, gold will continue to shine not just as a precious metal, but as a beacon of hope, and an ominous warning of the economic pitfalls that lie ahead if current trends persist. Stay alert, stay informed, and join us as we continue to peel back the layers of these economic issues to reveal the truth behind the headlines. After all, in a world run by policies made in smoke-filled corridors, our job is to bring a little clarity, and a whole lot of skepticism, to the table.